The first line of the annual map is the income line. Put salary, bonus, year-end pay, commissions, freelance revenue, rental income, interest, dividends, payouts, and other income on one timeline. The purpose is to see when income is concentrated and which income should not be spent immediately. Mark unstable income separately. Bonuses, commissions, side business payments, rental income, investment payouts, and one-time asset sales should not be treated like ordinary salary. A practical habit is to split unstable income into three buckets: reserve rebuilding, tax cash, and then investing or spending. If the eventual tax bill is lower than expected, the family has extra flexible cash. If it is higher, the payment does not become a crisis. The second line is the document line. Many tax-related items depend on records gathered throughout the year. Insurance premiums, medical costs, school spending, mortgage interest, charitable giving, rental documents, family support records, investment transaction statements, foreign currency records, and business expenses. Rules differ by location and status, so the map should not assume eligibility. It should create a monthly document folder and a question list for a qualified expert. The first mistake is assuming that every expense creates a tax benefit, while ignoring limits, eligibility, filing status, or required evidence. The second mistake is having a valid record but losing it across email, phone photos, paper folders, and broker statements. It needs a predictable place for records and a repeatable review routine. The third line is the tax cash line. Tax cash should be treated as a future bill, not as spare investment capital. If you have self-employment income, rental income, realized investment gains, insufficient withholding, or a year of unusually high income, it may be wise to keep a conservative reserve. The exact percentage is jurisdiction specific, but the principle is broad. Money that may be needed soon should stay liquid, understandable, and low volatility. Separate tax cash from emergency reserves. Emergency reserves cover job interruption, medical events, and urgent living costs. Tax cash covers a known or likely payment. If the two are mixed, the family may believe it has 6 months of reserves, while half the account is already assigned to taxes, insurance premiums, tuition, or mortgage costs. A good money map prevents the same cash from being counted twice. Taxes should not be the only reason to buy or sell an investment, but investment decisions can create tax and cash flow consequences. Better planning checks portfolio allocation, realized and unrealized gains, upcoming cash needs, and expert questions before the final weeks of the year. Investment planning also depends on time horizon and account type. Money needed within months should not be placed in volatile assets because of a possible tax benefit. Long-term assets should not be traded constantly because of short-term tax anxiety. Funds, ETFs, individual stocks, bonds, real estate, and foreign currency assets may all have different reporting and cash flow effects. The fifth line is the family duty line. Marriage status, dependents, children, parents, shared mortgages, school costs, insurance beneficiaries, gifts, and family spending duties can make cash flow and taxes more complex. The annual map can assign ownership, who collects documents, who tracks dates, who checks cash reserves, who asks expert questions, and who reviews large upcoming expenses. The sixth line is the major date line. Put filing season, estimated payment dates, insurance premiums, mortgage resets, tuition dates, lease renewals, vehicle insurance, medical spending periods, bonus dates, and portfolio review dates on one calendar. When too many large dates cluster in one quarter, the family needs extra cash before that quarter begins. In the first quarter, list last year's unresolved documents, expected income, major expenses, and family changes. In the second quarter, review withholding, cash buckets, insurance payments, and possible investment tax events. In the third quarter, adjust before it is too late. Check missing records, income changes, deduction questions, and whether too much short-term money is invested. In the fourth quarter, organize and confirm rather than panic. The first quarter is about having a skeleton, not a perfect answer. Instead, create 3 scenarios: normal income, higher income, and lower income with an asset sale or special event. For each scenario, ask where the cash would come from, which records would be needed, and which month would be tight. The second quarter is a good time to check withholding and cash. Employees can compare take-home pay, withholding, and expected bonus patterns. Freelancers can compare revenue, expenses, and cash reserved for taxes. Investors can see whether realized gains, losses, dividends, or payouts have already occurred. Landlords can review rent, repairs, vacancy, and proof. The third quarter is the adjustment window. Review missing documents, higher than expected income, deduction eligibility, portfolio rebalancing, and large spend if there are mortgage, insurance, school, medical, elder care, or business expenses. Confirm the evidence and cash plan now. The fourth quarter should not become a season of impulsive tax moves. A common mistake is buying products, selling assets, or creating transactions simply because the calendar is almost over. Before any tax-related move, ask 3 questions. Does the action fit the family goal even without the tax angle? Is the tax treatment certain enough and properly documented? After tax effects, are cost, liquidity, and risk still reasonable? The annual money map can also reduce investment anxiety. When short-term tax money, tuition, insurance premiums, or home expenses are clearly separated from long-term capital, the family is less likely to sell investments under pressure. When long-term money is protected from short-term bills, the investor can tolerate market movement more calmly. For salaried workers, the first practical action is to split bonuses and year-end pay by purpose. Do not treat the whole bonus as free spending or new investment capital. Allocate first to tax reserve, insurance premiums, emergency reserve repair, known annual expenses, and then long-term investing or flexible spending. For freelancers and side business owners, income volatility and insufficient withholding are major risks. Each payment can be split immediately, with the tax portion moved to a separate cash bucket. Contracts, invoices, receipts, business expenses, and payment records should be stored monthly. The account balance is not automatically spendable money if part of it belongs to future tax or operating costs. For investors, the map should mark possible realized events. Selling assets, receiving payouts, converting currency, bond maturities, real estate transactions, and private company equity events may all create records and cash needs. Investment decisions still depend on allocation and risk, but tax cash flow should be visible. If the next year includes buying a home, retirement, school, relocation, or family care, avoid being forced into trades at year-end. If one person manages investments and another manages spending, tax, cash, and documents can fall between them. One person may collect documents, another may maintain the date calendar, and both may review the cash buckets. Money management includes execution on important dates, not only return percentages. A useful map has 5 columns. Column 1 is date, income, filing, due dates, renewals, and large spending. Column 2 is amount, known amount, or estimate range. Column 3 is source, salary, investment, rental, business, insurance, or family support. Column 4 is cash bucket, where the money will come from. Column 5 is document, what evidence or expert question is needed. These 5 columns make monthly review possible. Create a red flag list. Red flag 1, income is much higher this year, but tax cash has not increased. Red flag 2, many investment payouts or sales occurred, but records are not saved. Red flag 3, all emergency reserves are invested. Red flag 4, documents are scattered across email, phone photos, paper, and broker portals. Red flag 5, taxes, insurance, tuition, and mortgage costs cluster in one month. A red flag is not a failure. It is a prompt to update the map. Remember that tax rules vary by country, region, income type, family status, and year. A video cannot apply one rule to everyone and should never promise tax savings. The repeatable part is process, list income, reserve cash, store documents, mark questions, and ask qualified experts when needed. A good process may not reduce taxes, but it can reduce surprise, rush decisions, and cash flow disorder. After filing season, do not close the file and forget it. Use the result to improve next year's map. Which income caused pressure? Which document was hard to find? Which month was tight? Which investment action had the largest cash flow effect? The answers become next year's planning checklist. Family finance is not a once-a-year exam. It is an annual system that gets easier when it learns from the prior year. Add an evidence ladder to the map. The first level is known facts, pay slips, broker statements, rental contracts, mortgage records, insurance notices, tuition invoices, and prior filing results. The second level is estimates, expected bonus, possible side income, likely payouts, and known family expenses. The third level is questions. Which items need expert confirmation, which rules changed this year, and which transactions should not be completed before advice. Separating facts, estimates, and questions keeps the family from acting as if every number is equally certain. Use a scenario matrix instead of one forecast. Scenario 1 is a normal year, income, withholding, and spending stay close to plan. Scenario 2 is a high-income year, bonus, freelance revenue, asset sales, or payouts increase, so tax cash and document work must rise early. Scenario 3 is a stress year. Income falls while medical, family, housing, or school expenses increase. The map should show what cash is protected in each scenario and which decisions would be delayed. Finally, connect the tax map to family return on effort. The goal is not to find a clever trick every year. The goal is to reduce forced selling, late borrowing, missing documents, avoidable penalties, and rushed product decisions. A simple map that prevents one bad liquidity decision may be worth more than a complicated plan that nobody updates. The best system is boring enough to maintain and clear enough for the whole family to follow. One more useful check is ownership. If nobody owns the calendar, nobody owns the outcome. Assign the map, document folder, cash bucket review, and expert question list to named family roles.